The UK economy is in a perilous position, and with a reported £22 billion black hole left in the budget, the PM has made his clearest statement yet that taxes are going to rise in the next budget in October, saying that it will, quote, be painful. But the real question is, which taxes are going to rise and how are they going to affect your financial journey? So in this video, we're going to split it into two. We're going to go through the taxes that have been proposed in Labour's manifesto, and as a bonus, we'll also go through some of the other changes which weren't in the manifesto but have been speculated or leaked to be on the table in October. With over 20 tax rises being speculated, including potentially big changes to your ISA and your pension, you really need to be taking note. But I think really we should be laying the land quickly, and I think it's important that we set the scene to give a full picture. The truth is that, to some degree, Labour have hemmed themselves in. When they were on the campaign trail, they said endlessly that they weren't going to raise the three big personal taxes, income tax, national insurance and VAT, and that they weren't going to raise corporation tax. And you can see on this diagram that those three taxes make up between 70 and 80% of all tax revenues in the UK. So if they can't get the money from there, then they'll have to focus on this little bit here that's left. But where's the money going to come from? And that's ultimately the question we're going to try and answer here. But starting off with what they've already announced is VAT on school fees. So at the moment, providing education is exempt from VAT, and so the 20% rate doesn't apply to private school fees. But I've got to be honest, the truth is that this isn't going to raise a whole lot of money. Labour estimate it will raise about 1.6 billion, and that the money will go on funding new teaching spaces and more teaching assistants. I've seen the estimates vary, but in any case, when there's a £22 billion hole in the public finances to fill, it's not even really going to hit the sides. And just an interesting anecdote, I have a friend who works in wealth management, and he said that people are dipping into their investment accounts to prepay on future school fees, even if they're incurring charges. But the truth is, there may well be a cap in the legislation on how many years you can prepay anyway. The non-dom status. The non-dom is a UK resident whose permanent home or domicile for tax purposes is outside of the UK. And one of the things that people assume incorrectly is that it's to do with nationality, citizenship or resident status. And what this means is that a non-dom only pays UK tax on the money they earn in the UK, so they don't pay tax on all the money that they will earn elsewhere in the world. So for wealthy individuals, this represents an opportunity for significant saving that are entirely legal, especially if they choose to domicile themselves in a lower tax rate jurisdiction. The new Chancellor Rachel Reeves said that Labour's changes could raise over 2.6 billion over the course of the next Parliament. So again, it sounds like a lot of money, but in the course of a government that will spend about £1 trillion per year, it's not a whole lot. Stamp duty. So Labour confirms that Jeremy Hunt's autumn 2022 decision to temporarily raise the threshold at which first-time buyers will pay stamp duty will not be renewed. It currently sits at £425,000, but will return to £300,000 in April 2025. Labour have also announced that there will be an increase in the surcharge for overseas buyers from 1% to 3%, with London property being bought by overseas investors being the obvious target here. But it may not be as effective as you think, and more on that later. And stamp duty is such a weird tax. Polling claims that stamp duty, or the land duty tax as to give it its full name, is the second most hated tax in Britain, second only to inheritance tax. And it's a terrible tax as well. And before people start screaming about first-time buyers, the empirical evidence shows that cutting stamp duty increases house prices. Ultimately, the money that people saved on their stamp duty can just get ploughed into spending more for actually buying their home. And this adds to an ever-growing list of schemes that are supposed to have helped first-time buyers but have actually just ended up juicing the housing market. Help to Buy being another prime example. Again, just pumping the housing market. But there is much more to stamp duty that's otherwise been speculated, but we'll cover more of that later on in the video. Capital gains tax. Now, we're going to go through a particularly weird part of the capital gains tax legislation, which is the carried interest loophole. And this is mostly from how hedge fund managers earn compensation for managing a fund. In the UK, this income is taxed as capital gains rather than ordinary income, which is a bit weird. And the key advantage of that is that capital gains taxes are typically way lower than income taxes. So this is why it's referred to as the carried interest loophole. Here's how it works. When private equity will go into a business, the profits that they make are realised, and then the carried interest is taxed at capital gains rather than income. And the loophole basically has been criticised because it allows these high-earning, high-flying hedge fund managers to pay significantly less tax on what is effectively compensation for their work, as opposed to an investment return on money that they're investing. And this is basically because they're usually investing other people's money, so they're not necessarily assuming the risk themselves. This is a loophole that Labour are going to close basically just by reclassifying income. Labour plans to reclassify carried interest as ordinary income rather than capital gains, which would mean that these fund managers are paying income tax rates on their carried interest. The British eye. We find ourselves here again, but okay. The British ISA still seems like it's very much here to stay. Not sure what else to say other than I'm not a fan. And my disdain largely is because only about 5% of people in the UK even have a stocks and shares ISA, and less than 1%, I think it's 0.5% of people actually hit their limit in a given year. But whilst it's difficult to complain about an extra £5,000 a year in allowances, wouldn't it just have been preferable to increase the main allowance by £5,000? It's been at £20,000 since 2017, so if you apply inflationary uplift, it should be about £20,441. And there's also other problems, like how do you find what is a British company? Is it that it's traded in UK markets? Is it a company that derives most of its income from the UK? It's those sorts of things which make an already complicated tax code even more complicated for a benefit that is basically for less than 0.5% of people in the whole of the country. The big one, income taxes. Now, I know what I said at the start, rates aren't going to go up. By freezing the tax bands, as people pay increases, it pulls them into higher bands. This is known as fiscal drag, and it's been the secret weapon of chancellors for decades. So whilst this is not anything new, rates ultimately are going to stay frozen until at least 2028, and this is going to be a real big money spinner for the government. And just anecdotally, there's also been some analysis done on scrapping national insurance altogether and instead rolling it into income tax. This would certainly ease the administrative burden, because having two taxes that are charged at different rates but not on the same thing, one has an upper limit which makes it regressive, blah, 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 all that sort of thing. So this would be a big change, and certainly one of the more interesting ones which are being explored. So whilst income tax rates so far aren't going to go up, by freezing the bands, it is effectively, in real terms, a tax rise. Inheritance tax. Now, we mentioned inheritance tax is polled as being the least popular tax in the UK tax code, but I think there are quite a few misconceptions around it. It's incorrectly viewed as being a tax on everyone's death, but what people get wrong is that only about 3 to 4% of estates actually pay inheritance tax, and that's largely because of the reasonably generous thresholds. You get £325,000 per person, so for a married couple that doubles, and given that pension pots are excluded and the average home in the UK is generally someone's biggest asset, and that's around £256,000-ish, the truth is that most people just fall below those thresholds and so won't be liable for inheritance tax. Now, whilst there's been no confirmation about much else changing, Labour have indicated that offshore trusts will now also be liable for inheritance tax. I don't know about you, but I don't know many regular people who have offshore trust funds to shelter themselves from inheritance tax. But aside from those proposals, there was no other reference to inheritance tax in Labour's manifesto, but there are reportedly plans to make big changes to inheritance tax, but we'll cover that in the second half of the video. And so now we move on to the second half of the video, where we're going to go through taxes that haven't been announced but have been largely speculated or leaked. What are going to be the tax targets, and what are going to be the monetary levers that the Chancellor and the Treasury decide to pull? Let's get into it. But just quickly, if you're new to this channel, please subscribe. It really helps us grow this finance community. Doesn't cost you a penny. And if you think I'm full of shit, you can always unsubscribe later. Really appreciate it. Next, we're coming back to capital gains tax. And I know we've already discussed it once, but the truth is that there are a whole plethora of potential changes that they could decide to make here. So let's go into a couple of them. But the first thing is to say that rates are lower for income from capital, and that really is a key way that the wealthy choose to build their wealth and pay less tax at the same time. You could bring capital gains tax rates in line with income tax rates. This is certainly an idea that's been floated around, and the empirical analysis suggests that aligning capital gains tax rates with income tax rates could significantly increase government revenue. According to a report from the Institute for Public Policy Research, a change like that could generate approximately £90 billion over 5 years. The Office for Tax Simplification, catchy name, has estimated that the alignment could raise about £14 billion per year. Another potential change you could make is to just raise the capital gains tax rate, but only for returns that are above the rate of inflation. So by fully equalising capital gains tax rates with income tax rates and only taxing on gains that are above the rate of inflation, this would raise potentially between 16 and 17 billion, according to analysis from the University of Warwick. But the critical thing is that you pay tax when you sell the asset and realise the profit, stamp duty. And we've discussed about how stamp duty is a very broken tax. It doesn't do anything like what it should do. It forces people to stay in homes much longer than they might want to for fear of a big stamp duty bill. It reduces flexibility in the housing market, is a huge transaction cost, blah, blah, blah. I could go on. But there are a couple of options available to the government when it comes to stamp duty. You could eliminate the stamp duty loophole for enveloped property. It's common that high-value commercial property is sold through a single-purpose company which is set up just for that transaction. This is known as being enveloped. And so instead of stamp duty tax being paid at 5%, the buyer pays stamp duty at 0.5%. And again, this is often done by an offshore company which will pay no stamp duty at all. It seems insane. This is another kind of loophole that is exploited by the ultra-rich, buying a £100 million mansion in central London or in Kensington or wherever and paying no stamp duty at all seems insane. And some estimates put that the figure is £100 billion of UK property has been bought through this mechanism in the last 6 years. £100 billion. Capping tax relief on ISAs. As we know, money held in ISAs will generally be exempt from income tax and capital gains tax. This costs the Treasury about £7 billion a year in lost income. But the truth is, most people don't have vast sums in their ISA. Only about 20% of people who even have an ISA have more than £50,000. So the truth is, the government start to introduce caps. Maybe they have a single one-off cap and everything above that cap gets charged tax. But this doesn't seem that fair. The ISA plays a really important role in people's wealth building journey in the UK. So to see retrospective changes applied would be a really disappointing outcome. And I think would just be completely counterintuitive and completely backwards. So needless to say, I'm not a fan of this one. A wealth tax. Now, a wealth tax would basically require taxpayers to make an annual declaration of their total net worth. They would need to produce all kinds of documents in order to back up this number. And this would be potentially an enormous administrative burden, not just for people to submit, but for the government to hire all the necessary accountants and so on to go through these declarations. So initially, this already has problems right up front, but this could raise, depending on how the wealth tax is charged, between £1 and £26 billion. There are plenty of campaigning groups who are really keen on a wealth tax targeted at very, very wealthy people, say with assets of more than £10 million. But in reality, the handful of countries that have actually done them have not seen a great deal of revenue raised. The recent Spanish tax has only raised about €630 million. Inheritance tax. Now, the inheritance tax code is filled with loopholes, and some egregious examples always seems to come out. It seems absolutely mad that this 25-year-old can inherit a £9 billion fortune and only paid £9 million in inheritance tax. But if you've got a house that appreciated in a smart part of town, then you could potentially lose 40% of that right off the bat. And so this one has been speculated as being very much on the chopping block and could well be ripe for reform. Pensions. Now, oh my goodness, this is the big one. Now, it's hard to raise the sort of money that the Treasury needs necessary without hitting pensions after you've excluded all the other taxes we mentioned at the start. Right now, contributions to a pension are fully tax deductible. So let's just take a look at this diagram quickly. In order to make a £100 pension contribution, the lower your income tax bracket, the more of that money you actually have to stump up to make the contribution equal to £100. If you're a basic rate taxpayer, then you put in £80 of the 100 and the difference will be from tax relief. But if you're a higher rate taxpayer, you only have to put in £60, and if you're an additional rate payer, you only have to put in £55, with the rest of the balance being made up as tax relief. And some people view this as unfair, and so the suggestion has been to limit tax relief to 30% or even 20%, and that could raise anything from £30 to £15 billion per year. If you inherit the pension of someone who dies before the age of 75, it's completely tax-free. But if they die at 75 years and 1 day, then the beneficiary has to pay tax at their marginal rate. So ending this relief could save about £1 billion a year. Another possible option is, at the moment, pensions don't form part of a person's estate. You could change that so that pensions are included in the overall value of the estate. Another option is ending the pension tax-free lump sum. Now, basically, when you retire, you can withdraw up to 25% of your pension pot, up to £268,000 as a tax-free lump sum. Now, the argument for this abolition is that the benefit mostly goes to people on higher incomes who have higher marginal tax rate, but who also have bigger pension pots. Fuel duty. There was temporary relief of 5p a litre, which is going to expire. Now, whilst this isn't the Labour government actively increasing fuel duty, they can just let it expire. This could raise potentially about £3 billion. And fuel duty, again, is one of those taxes which, in theory, disincentivises people from driving petrol-powered cars, but that's for another video. You could tax gambling winnings, which would raise between 1 and 3 billion, depending on how you taxed it. Now, interestingly, the US does tax gambling winnings, whilst we don't in the UK. And aside from the money this raises, it does have the added benefit of potentially discouraging people from gambling in a way that increasing betting duties might not necessarily. And you look at some of the amounts that people spend on gambling and some of the really worrying statistics, and that is potentially quite a big benefit. Specifically, increasing council tax for valuable properties, which would raise between 1 and 5 billion a year. And it's absolutely indefensible that an average property in Blackpool pays more in council tax in a year than a £100 million penthouse in Knightsbridge. So the obvious answer is to just uncap council tax, and so this means that the amount of council tax that people pay will be a much closer relation to the value of their property. Now, whilst Labour have committed to not necessarily changing the bands, I think just adding more bands for some of these super high value properties seems like a perfectly reasonable thing to do. Council tax is one of the most regressive taxes imaginable, and that's basically because it's capped. It just means that if your house is worth over, I think it's £350,000, you get away basically scot-free. So what have we learned? What have we discussed? And in conclusion, it seems as though pensions are likely going to be in the firing line. You can't necessarily raise the sorts of money that you need to raise without looking at pensions, but the more money you want to raise, the more radical the government will need to be. Once you exclude the 70 or 80% of the big taxes, you have to start making all kinds of tweaks to the taxes that are basically left at the bottom of the barrel. And unfortunately, I think the UK tax code is about 26,000 pages. Just adding more taxes will make it even more complicated. So be interesting to see what they do in October, and as always we will have a video covering just that very topic, and I think that's one thing that we really just cannot escape from. And so this really emphasises, I think, the need to manage your tax bill. Luckily for you, we have a video that covers just that very topic just here, where we go through all the ways you can legally manage your tax bill. We also have a whole series of videos about the UK economy, which you can watch just here. Thanks very much for watching, and as I said, if you've enjoyed this video, please like and subscribe. It doesn't cost you anything, and you can unsubscribe later if you like.